Hello, dividend growth stock investors. Happy Sunday to you. It is Colby, the DGI Crab, here to talk about the undervalued stocks in the market going into the trading week of August 18th. Always good to sit back for a little while on the weekend, make a plan of attack for how you are going to allocate your new investment dollars for the upcoming trading week. If you are new to the channel, what I've done here is I have themed the channel around 60 high-quality dividend growth stocks, split into 4 separate categories or tiers based off of the age and time horizon of the investor, which I believe is the most important metric that any dividend growth stock investor should take into consideration. How far away are you from retirement? How much do you need to focus on growth versus high yield? That's what we are here to talk about and more here today as we look to acquire dividends for that sweet, sweet passive income that is going to allow us to get out of the rat race a bit earlier than everybody else and give us a growing stream of tax-advantaged income. Gotta love that, you guys. That is what dividend growth investing is all about. Now, I'm not a professional financial advisor, and the content of the channel should be considered primarily for entertainment, and the opinions expressed regarding investments are my own. You should always perform your own due diligence prior to investing your hard-earned money. I am simply here to share my personal strategy with you. Maybe it gives you some ideas for how you want to handle your dividend growth stock investing. The way I personally do it is I put at least 50% of my money each and every week I invest into age-appropriate ETFs. We're talking stuff like VIG, SCHD, VOO, depending again on how old you are and what your time horizon is. When it comes to individual single stocks, I am looking to find stocks that are yielding 30% or more above their 4-year average yield. And then there are some exceptions to whether or not I will stay within my age tier of stocks and all of that stuff. But we'll talk a little bit about more as we go into the lists here, and you can see exactly what we are looking at going into the upcoming week. So guys, this is tier 1, the age 18 to 30-year-old investors, where we have stuff with lower starting yield but much faster dividend growth. Talking dividend yield and averages in the mid 1% range, but what we want out of this group of stocks is comfortably above 10% year over year dividend growth. You want that growth to compound because let me tell you, you guys, it takes a little while. But you get a big pile of one of these tier 1 stocks that you have just added to for years upon years upon years in your early days, and all of a sudden you're sitting there in your 40s and your 50s, and one of these stocks pops off with an annual dividend increase of 15%. That can be a very substantial amount of new forward annual dividend income added to your portfolio that you built up plenty of years before, but now you're reaping the benefits of those massive dividend increases. That's the kind of stuff you want to do to your portfolio when you're young, when you don't have enough capital to generate enough dividends to come close to retiring off of anyway, even if you were focusing on really high yield stuff. Focus on the growth aspect, laying the foundation of a passive income portfolio that's going to grow rapidly. United Health, you guys, as the week went on, we found out that Warren Buffett and a bunch of other bigwig fancy pants investors have been buying United Health as of late, and United Health finally recovered back up. It was down into the mid 200s. I was buying it all the way down there. I've been buying it since it dipped below 400, to be honest. So it was nice to be getting it all the way down at 250-ish, 260. But now it recovered a bit. And I think that United Health may not be a stock that's going to shoot up into the stratosphere anytime soon. But I do think that it was very unjustly punished. And you had a great opportunity to get it down in the 200s. I think that down here below 400, it's still great for a long-term play if you could wait for United Health to recover. UNH, Nike, Nordson, these are the 3 stocks in that aforementioned buy zone where the 4-year average yield or their current day yield is at least 30% higher than the 4-year average yield. All right, guys, tier two, age 31 to 41-year-old investors. This group of stocks, it's going to be a bit of a higher starting yield in this group. More in the mid 2% is about average, but we're looking for deals here. So usually you're buying stuff in this group when it's yielding more in the 3% or better range. We want high single digit year over year dividend growth out of this particular group. We got four stocks in the buy zone out of this group. Target is in the super undervalued category here of more than 50% off the 4 year average yield. So Target really could be one where the green light is on for other age tiers to jump in and also add a little bit to it. You are getting a really high starting yield right now with Target at 4.35%. I'm still expecting pretty lackadaisical dividend growth out of Target for the next few years. So that's going to be the trade off. You'll get your yield now. The growth is probably not going to be as good as it historically has been with Target, but I don't think their dividend is in any danger of being cut. It should continue to grow. Pretty good starting yield though to go right in there if you know going in that it's going to take a little while probably. And then we've got this nice trio here of American States Water, Hershey, and McCormick, all in that buy zone range as well. I did something I usually don't do very often with stocks, but with McCormick I did like a little churn. Where at one point this week it got down into the $68 range. I added $500 to my position. And then a day later, it was in the just below $71 range. I sold $500 exactly. And what that left me with was just shy of a quarter of a share of McCormick as a profit added to my long term hold position. And then on Friday, when it dipped back down below 70 again, I actually did just go ahead and just toss another $50 in there at my McCormick position. It's right where I want it. It's a super steady stock, and this is about the point where I'm happy to buy it. If it gets a little bit lower, I will add even more. But McCormick is just about for the last 9 months now. It goes up into the mid to high 70s, maybe even hits in that $80 range, goes out of our buy zone. We leave it alone, and then it creeps back down here, gets into the buy zone. We hammer it hard while we can, and then it recovers and goes back into the non-buy category. So I like that my window is open on these stocks right now. Hershey very briefly this week actually got out of the buy zone. It recovered so much. But fortunately for me, I get to continue to add to my Hershey position. The more it stays down here in the 170s, the happier I will be. I'm going to keep adding to that position. Tier 3, 42 to 53-year-old investors, starting yield gets a little bit higher in this category, and it also gets a little bit slower on the growth. 3 to 4% starting yield, 4 to 6% dividend growth is probably what we're looking at here. We used to have a lot of values here in this particular tier, but right now we're just left with two, Hormel and Pepsi. Pepsi, one of my top 10 favorite dividend growth stocks, regardless of tier. Happy to buy this one whenever it's showing any real signs of undervaluation. And really right now, Procter & Gamble, still happy to add Procter & Gamble if I'm in that tier 3 category right now. Not super underpriced right now. The 4 year average yield at 2.42%, currently yielding 2.74%. That's about 13% discount if we're looking at the yield as our discount model, which is what I'm doing here. Not a bad deal for a super high quality stock like Procter and Gamble. Hormel, kind of another one like Target. I'm just not expecting amazing dividend growth out of Hormel in the short term at all. And the stock price is really, really taking a beating as a result of expected slower dividend growth. But my entry point right now at 4% or better is certainly appealing because, again, I think I'm going to get dividend growth out of this one. It might just be a little bit slow in the shorter term. Tier 4, age 54 and older investors, we're a lot more focused on higher starting yield in this category now, you guys. Still want to get some dividend growth, but probably we're going to expect it in that 2 to 4% range just to kind of keep up with inflation in most years. Our three REITs are still the most undervalued in this category with Essex, NNN, and Realty Income. But for right now, nothing in this category looks to be super appealing. Realty Income, though, just announced another nice little dividend increase of about 2%. This is a big one for Realty Income because they'll do multiple increases over the course of a calendar year. And they've really done a nice job of increasing their dividend despite trading kind of on the cheap for a good portion of the year. So, congratulations, Realty Income shareholders. So, the strategy or the way I allocate my money in each tier would look a little bit like this. For the half of the money that goes into ETFs each week, my breakdown for tier 1, the young folks, would be 25% VOO, S&P 500, 15% small cap value, 5% VIG for dividend growth, 5% VYMI. That is my only non-US investment. I do 5% into VYMI all across the way in all age tiers. Tier 2, same for different allocation. 25% goes into VIG for dividend growth, 15% into the S&P 500, 5% into the small cap value. And then tier 3, I'm going to be graduating into tier 3 in just a few months, November just around the corner here. And my allocation is going to be into these three dividend ETFs, SCHD, VYM, DHS. I think these are the three best in their particular category. And this is about how I would allocate between the three. And then for tier 4, lots of different things here with tier 4, 10 different ETFs with allocation of 5% each to get me up to that first 50% of my money invested each week. And I've got totally separate videos on ETF investing strategies. You can find them in the description below or in the ETF playlist that I have made. I've made a lot of different playlists on the channel. Hopefully it'll make looking up some of the information about my strategy a little bit easier. Now, if we look at the other 50% of the allocation for our single stocks here in that tier 1 category, my main priorities are going to be getting United Health while it's still trading super cheap, Pepsi because it's a personal favorite of mine, and then Nike. Nordson and Target are also in the buy zone for the tier 1. So I'm basically getting the three that are in my own tier 1 category with UNH, Nike, and Nordson, and also making some room for Pepsi and Target because they have hit buy thresholds for me in the other tiers. In tier 2, I'm going to prioritize Pepsi, Target, and United Health. I'm going to clean up the rest of my tier by dipping into American States Water, McCormick, and Hershey. And I'm also going to continue to add to Union Pacific. This is another one that's in my top 10 favorite dividend growth stocks. Union Pacific in tier 2, not strikingly undervalued, but about sort of where that Procter & Gamble is in tier 3, right? It's about 12-13% off. I could get a 2.5% starting yield right now when the 4-year average is 2.22. That's just about good enough for me to want to continue to add to that UNP position. I added a little bit to my UNP this week as well. Tier 3 investors, so they get to basically hit Pepsi, UNH, Target, Hormel, Procter & Gamble, and that's really about it for that group. Pepsi, top 10 favorite, Procter & Gamble, a top 10 favorite. That's making up some of it. Hormel's the other undervalued one in that tier 3 category. And then UNH and Target from the other tiers are in that 50% higher starting yield category, but this kind of rounds it out. And then really the only single stock to emphasize in that tier 4 group might be to just keep adding on to UNH until it fully recovers. Not as high of a starting yield as you might want in your 50s, but I think you're going to get an opportunity for both that number to grow and the share price to grow as well. So that is another video for the week. You guys, what are you buying down there below? Have you been like Warren Buffett and DGI Crab and loading up on UNH? Let me know down in the comments. And until next time, keep adding to your forward dividend income with those sweet dividends.